I think what you're seeing is there is definitely some investor fatigue, and I don't want to say that from a sort of retail investor perspective, but I think there's a bit of fatigue at the professional investor, the advisor level as well. And, as much as it's something that we try to drive home with our clients, that we're looking at it from a long-term basis, these day-to-day trades that are happening, if you look at your underlying portfolio, you can start to lose a little bit of confidence in some of the names that you own. You can start to second guess. And so I think it's really important that if you're looking at a stock, there at home or here on this panel, that you make sure that you're very clear about what the investment thesis is, and that it is not based on whether you think there will be XYZ resolution in the trade talks, or whether you think the Fed will do this number of rate cuts this year. I think it's really important to think long-term about the competitive nature of the businesses you own, and I think that's even more important when we're seeing this constant torrent of tweets that we're being forced to react to.
Yeah, so Josh, I think Bespoke sort of sums this up well today in sort of describing the mindset of the investor and what you're forced to deal with. They say, quote, "There is simply nothing worse than being blown out of a position because of a very short drop fueled by a combative Oval Office missive. We would suggest that tight, unmanaged stops simply can't be used in this sort of environment." We've talked about different, trading strategies using stops and otherwise. What do you make of that?
Well, I don't know what the context is. Is that written in a letter that's going out to a specific type of trader or investor? Because that may be the case. But then for other people, it wouldn't. It's very tough to give generalized pronouncements like stops aren't working or are working without understanding what your intention is with whatever pool of capital you're trading. Let's put that aside. If you've got the president on one side saying a call came from China, and then China on the other side saying that there was no call, if you're a professional trader and you think you have an edge on that game, you are a clown. So you probably don't. The real professional traders are not placing buy and sell orders based on rumors and innuendo in the press or whatever spokesman is saying to the press.
No, but their positions are being shaped by what you've just described in some respects.
So you're professional traders. What is happening is that their risk management might be changing, Scott. I think it's a more realistic bet to say that people who are managing money right now, rather than pretending in their own mind that they have an edge on whether or not the president is lying or China is not telling the truth, forget about all that. What they're saying is that they want to pull back their horns somewhat, and you see that. You see that in put call. You see that in percentage of stocks below their 200-day. That is what's really happening. It's not a question of, do I know what the next headline is going to be? It's a question of how much am I willing to lose if I don't know? And that, to me, is a big change from even just July. So that's the environment that we're in. I think it's reasonable. That is how people should be thinking if they're managing short-term money. They should be thinking about risk more so than what am I missing out on to the upside.
Fair point, but let's be clear. It's a chaotic environment.
Totally agree.
It has been a chaotic environment since the end of July. Here's the risk, though. The risk is that we have a similar situation to what we had President Obama, his first election attempt in 2012. If you go back to the summer of 2011, July 2011, the market fell from July 2011 until October 2011, 20%. If you took that and you extrapolated moving forward that it was time to bust up your portfolio, you walked into 2012 and you destroyed yourself over the coming years. Now, you have chaotic messaging that's going on right now in 2019. You have potentially, though, the opportunity to blow up your portfolio if you react to the volatility, because on the other side of that, the president might get his cuts, and you might be facing in 2020 the Federal Reserve, which maybe lowers 2 or 3 more times, and a resolution to the China deal. So I think the ballast right now is going back and looking at other places besides equities. There's a reason why low volatility S&P companies are up 19% year to date. We've been hammering home that theme.